In today's session, we will be taking up a question from the exam kit, the Alka Hotels. This is a question on marginal costing. So let's get started straight away. Now, whenever you get a marginal costing problem, it is better to arrange the data from the question in this format. So first you have the product name, then you have the budgeted units, then comes the selling price per unit. You reduce the variable cost per unit to get the contribution per unit. And finally, you take note of the total fixed cost. Once you compile all these information, it becomes very easy for you to find out the answer. Now let's get to the question extracts. As and when we read the question, we will key in the figures in the particular format. Alka Hotel has 25 double bedrooms and charges $180 per room per night, regardless of single or double occupancy. So the product that Alka Hotels is selling is room nights. That is one room for one night. So the amount that they are charging is $180. That is nothing but the selling price per unit. So that's 180. The hotel's variable cost is $60 per occupied room. So the variable cost is given. So we will write against variable cost per unit, $60. It is open for 365 days and has a 70% budgeted occupancy rate, which means that we can find out the budgeted number of units. We know that there are a total of 25 double bedrooms and they are working for 365 days and the budgeted occupancy rate is 70%. So what is the budgeted units? Budgeted units is 365 days multiplied by 25 bedrooms multiplied by 70%. That's the occupancy rate. So that's the budgeted number of room nights. Moving further, fixed costs are budgeted at $600,000 a year. So against fixed costs, we key in $600,000. Now the contribution per unit is selling price minus variable cost per unit. That is 180 minus 60. Giving an amount of $120 per unit. Now we will solve the budgeted number of units, that is 365 into 25 into 70% gives an amount of 6,387.5 units. So our format is complete. During Q1, the occupancy rates are lower, expecting to sell only 900 occupied room nights, which means that in the first quarter, the sales is slightly lower than the other quarters. Now, options to improve profitability are by adopting one of the two methods, Project 1, that's the theater package, and Project 2, that is the restaurant. Using current budgeted figures and ignoring the two proposed projects. So for the time being, we don't need to consider the two projects that are proposed. Calculate break-even number of occupied room nights and the margin of safety as a percentage. So right now we need to calculate the break-even point and the margin of safety as a percentage with the available information that we have prepared in the format. So the formula for break-even point in units is given by fixed cost divided by contribution per unit, and margin of safety in units is given by the formula budgeted units minus break-even units, and the MOS as a percentage is given by the formula MOS divided by budgeted units. So coming to the first formula, that is break-even units, it's fixed cost divided by contribution per unit. Fixed cost is 600,000 and contribution per unit is 120. So substituting those figures in the formula, we get 600,000 divided by 120 gives a figure of 5,000 room nights. That is, if they are able to let out the rooms for 5,000 nights, then the hotel achieves break-even. Now, the margin of safety in units is given by the formula budgeted units minus break-even units. Budgeted units is 6,387.5 and the break-even units is 5,000. So substituting those figures in the formula, we get 6,387.5 minus 5,000, which gives an amount of 1,387.5. And MOS as a percentage is given by the formula MOS divided by budgeted number of units. MOS, we know it is 1,387.5 and budgeted units, we know it is 6,387.5. So substituting those figures in the formula, we get 0.2172, or expressed as a percentage, it is 21.72%. So we are done with part A. Now moving on to part B. So this is the format that we had just prepared. Now let's see the question extracts. During Q1, they had said that the occupancy rates are lower, expecting to sell only 900 occupied room nights. Now, the second part asks you, ignoring the two proposed projects. What were the two proposed projects? In the question, they had mentioned the theater package and the restaurant. So for the time being, we are supposed to ignore those two projects. Calculate the budgeted profit or loss for Q1 and explain whether the hotel should close for the duration of Q1. So which means that we need to depend our calculations on the above format. So what is a budgeted profit? Budgeted profit for Q1 is given by budgeted contribution less the total fixed cost. So what is a budgeted contribution? For one unit, the contribution is 120, and the budgeted number of units for Q1 is just 900 room nights. So the budgeted contribution will be 900 into 120. And what is the total fixed cost for the first quarter? For the full year, it is 600,000. So for the first quarter, it is 600,000 divided by 4. So solving these figures, we get the budgeted contribution as 108,000 and the fixed cost as 150,000. Budgeted profit for Q1 as 42,000 negative, or we are incurring a loss in Q1. The question asks you, explain whether the hotel should close for Q1. There are two considerations that we have to see. Now, first, this fixed cost of 150,000 is fixed. Even if we close down for Q1, that fixed cost will still be there, correct? And we are going to lose 108,000 contribution if we close down for Q1, which means that budgeted contribution, if we close down for Q1, will be 0 and fixed cost will be 150,000, which means that our budgeted loss will be 150,000. So what is better? It is better to open it for Q1 because else we will lose the budgeted contribution of 108,000. And there is one more consideration that we have to take. If a hotel closed down for the first quarter, then what will be the reputation of the hotel in the market? That is, it is a hotel which closes down occasionally. That is, it is not a reliable hotel. So due to that reason itself, they might lose customers. So the final answer is, Alka hotels should not close for Q1 as contribution of 108,000 will be lost and the reputation of the hotel would be lost too. Now moving on to part C of the question. So we have the question extracts here. The hotel's variable cost is $60 per occupied room night. Project 1, this was the first project that was under consideration for reducing the loss in the first quarter. So for Q1 only, Alka Hotel would offer a theater package. And what is a theater package? Couples who pay for 2 consecutive nights at $67.5 per room night will receive a pair of theater tickets for a payment of $100. So the theater package is nothing but a stay for couples for 2 consecutive nights. So against the theater package, I am going to write 2 consecutive nights. The couples will get a pair of theater tickets for a payment of $100, which means that they will have to pay the room rent. What is the room rent? It is at $67.5 per room night. And they will also have to make an additional payment for the theater ticket. And what is the price for that? It is $100. So what is the selling price for the theater package? First, they get the room rent for 2 nights, that is 67.5 into 2, plus Alka Hotels get the theater ticket price of $100. So the selling price will be 67.5 into 2 plus 100. 67.5 is the room rent for 1 night. And since it is for 2 consecutive nights, we have to multiply it with 2 plus 100. 100 is nothing but the payment for the theater ticket. So we've got the selling price for the theater package and Coming to the variable cost, already the hotel is incurring a variable cost of $60. So anyway, $60 will come here. Then the theater ticket cost Alka Hotels $95 a pair. So the theater tickets has to be bought by Alka Hotels, which means that that is also a variable cost. So it is 60, which is the existing variable cost, plus $95, which has to be paid for the theater ticket. So what is the total variable cost? Please remember that it is for 2 consecutive nights. So the variable cost will be $60 multiplied by 2 because it's for 2 consecutive nights, plus $95, which is the cost of the theater ticket. So solving these figures, we get the selling price as $235 and variable cost per unit as $215. So the contribution comes to $235 minus $215, that is $20 per unit. Now coming back to the question, Alka Hotel's fixed cost specific to this project, marketing and administration are budgeted at $20,000. So $20,000 is the fixed cost relating to the theater package. So we make note of the total fixed cost as $20,000. Hotel's management believes that the theater package will have no effect on their usual Q1 customers, who are all business travelers and who have no interest in theater tickets, but will still require the usual rooms. It was mentioned earlier in the question that Q1 customers are 900 people. So what they are saying is these 900 visitors will definitely come, which means that we have to reserve room for 900 people. Now, calculate the break-even point in sales value of project 1 and explain whether the project 1 should be adopted. So they are asking you whether the project 1, that is a theater package, should be adopted. So first we will calculate the break-even point. So what is a break-even point in units? Break-even point in units is given by fixed cost divided by contribution per unit. Fixed cost is $20,000 and contribution per unit is $20. So the break-even point in units is 20,000 divided by 20 or 1,000 units. Please note 1,000 units is the 1,000 theater packages. Theater packages means 2 consecutive nights. So if you convert it into the room nights, then 1,000 theater packages is equivalent to 2,000 room nights. Why 2,000 room nights? Because each theater package is comprising of 2 consecutive nights. So 1,000 into 2, that is how I got 2,000 room nights. Now, so we got the break-even point in units, but they have asked you break-even point in sales value, which means that we have to convert it into dollar. So break-even point in dollar is given by break-even point in units multiplied by selling price per unit. So break-even point in units is 1,000 theater packages. And what is the selling price for each theater package? It is $235. So we get the break-even point in dollar as 1,000 into 235 or $235,000. Now the second part asks you whether project 1 should be adopted. Now for project 1 to be feasible, the break-even point is 2,000 room nights. Do we have 2,000 room nights in Q1? This is our next question. So let's read the question extracts once again. So they have said Alka Hotel has 25 double bedrooms. It's open for 365 days and has a 70% budgeted occupancy rate. During Q1, the occupancy rates are lower, expecting to sell only 900 occupied room nights. They are the usual customers. The theater package has no effect on the usual Q1 customers, that is these 900 room nights, who are all business travelers and have no interest in theater tickets, but will still need their usual rooms. Now we are trying to find out whether we have got 2,000 room nights in Q1. So what is the total rooms available in Q1? The total rooms available in Q1 is 25 double bedrooms multiplied by 365 days. Those are the room nights available for the whole year. So for the first quarter, we have to divide it by 4. So the total room nights available in Q1 is 2,281 room nights, out of which 900 room nights are already reserved for the usual customers. So we have to reduce the usual customers' rooms. So less the rooms reserved for usual customers, that's 900, that's coming from here. So what is the balance rooms available? The balance rooms available is 2,281 minus 900 or 1,381 room nights only. But our break-even point for the theater package is 2,000 room nights, but we don't have 2,000 room nights to provide. So which means that project 1 or the theater package is not feasible. So the final answer is, as balance rooms available, that is 1,381 room nights, is less than the rooms required for break-even, which is 2,000 room nights, project 1 is not feasible. Now moving on to subpart D. So we have the question extracts here. Project 2, that was a restaurant. So they have given a graph here. Annual costs, revenues, and volumes for the combined restaurant and hotel are illustrated in the graph. So we have the graph here. This is nothing but a break-even chart. The graph does not include the effect of the theater package. So that is not included. It is only the existing hotel plus the restaurant, which is portrayed in the graph. Now, use the graph to quantify and comment on the financial effect of project 2 on Alka Hotel. So we are supposed to comment on this graph, whether opening a restaurant is good or bad. So what we will do is we will extract the details from the graph and key in the format that we are familiar with. So the product is hotel plus restaurant. Now, the first thing is budgeted units. Now, if you see the graph carefully, the point at which the sales curve and the total cost curve meets, that's the break-even point, which means that 5,161 is the break-even point. Okay, from the graph, we know that the break-even point is 5,161. And what is the margin of safety? The margin of safety is budgeted sales minus the break-even sales, correct? So just look at the margin of safety arrow. It is extending from the break-even point to which point? It is extending till 7,300. And we know that the difference between the budgeted sales and the break-even sales is the margin of safety, which means that from the graph, we know that 7,300 is the budgeted units. So against the budgeted units, we have to write 7,300 units. Now coming to the selling price. So they have given a dotted line here and here. So look at the sales point. Okay. So for 8,000 units, they are telling you the sales in dollar is 2,000 and that's given in thousands. So $2 million. So what is the selling price per unit? $2 million for 8,000 units. So per unit, it is $2 million divided by 8,000 units. So what is the amount? It is $250. So we got the selling price. Now moving on to the second item, that's the variable cost per unit. Look carefully. Variable cost is total cost minus fixed cost. And for the 8,000 units point, the total cost is 1,560, that is in thousands of dollars, and fixed cost is $800,000. So variable cost is total cost minus fixed cost, correct? So total cost is 1,560 thousands. So I'm writing it with K, minus fixed cost is 800,000. So 800K. So what is the total variable cost? So the variable cost is $760,000. Okay. For how many units? For 8,000 units. So what is the variable cost per unit? It is $760,000 divided by 8,000 units. So we get the variable cost per unit from the graph as $95. Now coming to the contribution per unit. Contribution is nothing but selling price minus variable cost. So it's 250 minus 95 or $155. And the total fixed cost is the straight line, which is parallel to the x-axis. It's coming to 800,000. So this is the situation for hotel plus restaurant. Now we had already prepared the same format for the hotel only in part A. So what have they asked? Quantify and comment the financial effect of project 2, which means that we have to compare the existing hotel's profit with the hotel plus the restaurant's profit. So we will make a comparison between the two. So we will keep both the formats. That is the format that we have prepared now, that is the hotel plus the restaurant, and the format that we prepared in part A, that is for the hotel only side by side, and then we will make a comparison. Okay, so I have just copied the hotel plus the restaurant on the right side, and this is the information that we had got from part A of the question. We had already calculated the original break-even point in units, that's 5,000 room nights. The MOS we had calculated in part A as 1,387.5 room nights. MOS as a percentage we had calculated at 21.72%. So we will calculate the very same figure for the hotel plus the restaurant also. Only then can we make a comparison. So what is a break-even point in units for hotel plus restaurant? The formula is fixed cost divided by contribution per unit. So it is 800,000 divided by 155 per unit. So it is 5,161 room nights. Now coming to MOS in units. It is given by the formula budgeted units minus break-even units. So for the hotel plus the restaurant, the budgeted units is 7,300 and the break-even units is 5,161. So MOS in units is 7,300 minus 5,161 or 2,139 room nights. Now coming to the MOS as a percentage, it is MOS divided by budgeted units. So MOS we know it is 2,139 and budgeted units we know it is 7,300. So as a percentage, we get the amount as 0.29 or 29%. Now the final calculation that we have to do is we have to find out the budgeted profit for the hotel only and the budgeted profit for the hotel and restaurant. And then we can make the comparison. So what is budgeted profit? Budgeted profit is budgeted contribution minus the total fixed cost. So for the hotel only, the budgeted contribution is given by 120, that's the contribution per unit, multiplied by 6,387.5 units, minus the fixed cost of 600,000. So let's substitute the figures in the formula. It is 6,387.5, that's the budgeted units, multiplied by 120, that's the contribution per unit. So we get the total contribution here, minus the total fixed cost is 600,000. So we get the budgeted profit for the hotel alone as $166,500. And coming to the hotel plus the restaurant, what is the budgeted contribution minus fixed cost? The contribution per unit is 155 and budgeted units is 7,300. So budgeted contribution will be 7,300 units multiplied by 155 and the fixed cost is 800,000. So you have to reduce 800,000. So it is 7,300 into 155 minus 800,000, giving a profit of 331,500. Now we have quantified the entire data. Now all that you have to do is you have to write your analysis in words. So you have to write the budgeted units has increased from 6,387.5 to 7,300 units. The selling price has increased from $180 to $250. Variable cost per unit has increased from $60 to $95. The contribution per unit has increased from $120 to $155 per unit. The total fixed cost has increased from 600,000 to 800,000. As a result of which, the break-even point has increased from 5,000 room nights to 5,161 room nights. The MOS has increased from 1,387.5 room nights to 2,139 room nights. MOS as a percentage has increased from 21.72% to 29%. And finally, the budgeted profit has increased from 166,500 to 331,500. So whenever the question asks you to quantify, you find out what is the existing scenario and you find out the new scenario. So in this particular case, the existing scenario was a hotel only, and the new scenario was the hotel and the restaurant. Once you quantify the figures, the only thing that you have to write is in plain English. The existing scenario was this, and the new scenario was this. So it is increased or reduced or whatever the case may be. So that was the final subpart. I hope you've understood how the problem has been done. If you have benefited from the video, do click the subscribe and the like button, and do share it with your friends whom you feel will benefit from the video. So thank you all, and meet you in the next video.